Tamakaze here with a video on the dollar index and explaining its impact on overall markets. So this is something that not a lot of traders when they're starting out pay attention to, but something that should be understood and something that can be used in your repertoire to figure out where is the market going. So what I have here is our blue line is the dollar index, and I just have a simple explanation on the screen here, and I'll just read that real quick. So the dollar index is weighted up uh, how strong the dollar is in relative to a basket of foreign currencies. So often referred to as a basket of U.S. trade partners. So basically the dollar's strength versus its main trade partners. So the majority of the dollar index is the US dollar versus the euro, combined with Japan, Great Britain, Canada, Sweden, and Switzerland. So you can see the weights on the bottom here. So basically, as the dollar gets stronger, you'll see that the overall the euro, and the Japan will get weaker. So does this have an effect on the S&P 500? And I actually have the S&P 500 futures here overlaid against the dollar index because they both run on a futures-based contract 23 hours a day. That's a better correlation to look at futures compared to the dollar index. So overall, the dollar generally moves with the S&P 500 unless there's times of uncertainty like we've had for the last year or so. And then the dollar is treated as a safe haven for when there's times of uncertainty, and it can inverse the market. So for instance, you will see here, as the dollar gets weaker, we actually have the safe haven of the dollar then goes back into the markets, and as the dollar gets stronger, then you see the markets come back out. So what companies are doing then is they're putting their money into cash because the cash will be worth more than the market. So that's why in times of uncertainty, the dollar can be used, or the dollar index can be used as an inverse indicator of where the market is going, kind of like you would use the VIX or the volatility index. The dollar index can be used kind of in the same way. But if we get periods of stability, then you could see the dollar move with the S&P 500. And that's when you need to know that it's not always inverse, but because we've been worldwide uncertain of overall conditions from the coronavirus, you have seen strong inverse correlation with the dollar index compared to, say, in the past when the dollar may have moved with the S&P 500. So you could see when we had the crash last year, they moved together, and then after that they started inversing each other. So keep that in mind, that it's not always a full one-to-one inverse. Sometimes they move together. So for instance, after we got in March last year the stability issues with all the packages and everything, they started to move together. And here's again, they moved together. But since March of this year, we've had strong correlation with the inversing between the two, and that can be cause for concern. So hopefully this helped explain the dollar index a little bit better, and hopefully it can help make you a better trader. Thank you, and have a great day.